Hi everyone, and welcome back to Financial Basics, where we make money grow with you. Today I'm just doing a follow-on video for what to do for your child. The link to that video will be in the description. So that video was talking about making an investment for your child for their retirement and what that would look like. How much you would need right now or when that child is born, so that in 65 years you would have over $1 million or £1 million, depending on your guarantee and how much you start with. Today, I wanted to just answer some of the feedback that I've received of that video, which was very much around what types of accounts you would use for this, or what would be the expected accounts to be used for this. And I'm going to be talking about 3 accounts, and we can just jump to it. In the United States, there's an UTMA, or Uniform Transfers to Minors Act account. And then in the United Kingdom, there's 2 accounts that I want to look at. The one is a junior SIP, and the other one is a junior ISA. So for the UTMA, it's a US account. This is basically an account that allows gifts to be made to a minor. It's managed by a custodian. The investments, if they generate any sort of earnings, those are taxed in the year in which that income is earned, right? So if the investments that you put into that account are generating dividends, or if they are generating interest, then you would be liable for the tax on that at that moment. Anyone can contribute towards this account, so it doesn't just have to be the custodians or the guardians. It can be literally anybody in the family or even friends, whatever the case may be. Once the transfer has been made, so once those funds are in this account, it becomes very difficult to get them out or to get them back, right? So if you want to spend that money and you've already gifted it to your child, it's very difficult to get that money back, if not impossible, right? It can't be taken back. The money is also locked away until the child is recognized as an adult. This is just dependent on state law, but it's normally somewhere between 18 and 21. So nobody can touch this money and take this money out unless it's to the benefit of the child. And then under certain conditions or certain circumstances, the person creating the UTMA, depending on, again, state law, they can add a customized age of termination, so they can decide when this thing actually completes or finishes doing its thing and hands over those reins to the child. There could also, it's also worth noting for this type of account, there could be an impact on federal financial aid for college specifically, because when federal financial aid is being taken into consideration in terms of how much you qualify for, it counts as assets, and assets for the child actually count against the child for qualifying for this aid. So one of the tricks that I have seen around this was simply just converting the UTMA account, which can be used for anything, into a 529 account, which is specific for college or further studies. And that means that the child now would fully qualify for any federal financial aid, and those assets would count against them. The other thing to note is there are unlimited contributions per year, and any contributions above 18,000 per person, so that's 36 for a married couple filing jointly, they will incur a federal gift tax. The great thing about the UTMA, as I mentioned, is they can be used for any purpose. So it can be for a car, for a wedding, for college, for university, for just about anything that they want. It can also be used for their retirement. However, again, the contributions aren't tax deductible, and the earnings are subject obviously to federal and potentially state and local taxes. the other thing worth noting here is if the taxes are paid in the year in which they are earned, it means any taxes that occur during drawdown on there aren't any taxes for that, right? So if you're actually taking that money out, you're not paying tax on that because the tax has already been paid. So in the UK, the two accounts, one of them is the Junior SIP, which is a self-invested personal pension. So this has an allowance of up to 3,600 per year. Well, the guardians or the parents would contribute 2,880, and then you get a 20% match from the government through tax relief, which equates to that 3,600. Any earnings or capital gains taxes on this account do not apply, so it's completely free of UK income and capital gains taxes. And then the child's pension is often covered as well by the inheritance tax exemptions. So that's also something to investigate. Only a parent or legal guardian can open the account and manage the account on behalf of the child, but the same thing applies. Anyone can actually contribute towards it. For this account, the money is actually locked away until the child is 55. It's still a recognized pension. And I think come in 2028, I believe, April 2028, there are plans or discussions, at least at this point, to lock that away until the age of 57. So even 55 might be a little bit early. As per my original video talking about what to do for a child, we were looking at timelines where they would only really want to access this from the age of 65 onwards, or full-on retirement age. And then the other thing to note is once the child turns 18, they now have full control of the account, and they can allocate the funds inside of the account as they wish. They can't withdraw the money, but they will be allowed to actually access it and make changes to the investment portfolio. The Junior ISA, it's another account in the UK. You can invest in stocks and shares or all of the other usual range of assets. It's basically an investment account for a child. As per the previous accounts, the parent or legal guardian can open it and manage it on the child's behalf until they turn 18. Anyone can contribute towards it, and then any returns or anything generated from the account is also tax-free. The money is locked away instead of 55 because it's an ISA only until the age of 18. The cap for the allowance here is 9,000. So obviously the reason why they're putting these caps in place is because it is tax-free, which is why in the US with the UTMA account, it's uncapped. But that is a taxable account. And then once the child turns 18, it actually just converts into a normal ISA. So in summary, my advice would be to speak to a financial advisor to fully understand the consequences for you and your child for any of the above mentioned accounts. It's absolutely critical to make sure that these accounts are suitable for what you actually need and what your requirements are. And in summary, saving for your child is actually a great way to give them a head start in life. And if you take a look at my other video, having a 5,000 lump sum at birth invested over their lifespan for 65 years, giving them $1 million by the end of it, could actually save them potentially 10, 15, even 20% of their take-home pay every single month for their entire career, giving them a huge gift and something that I think they would appreciate for the rest of their lives. Please support my channel. There will be more videos like this coming soon. So if you want to get those videos, please subscribe. If you have any questions or requests, please email me. And I do have a question to ask. If you do have a financial question that you're really struggling with and you're not sure of, and you would like me to cover it on my channel, please let me know at financialbasicsabc@gmail.com. Thanks. Goodbye.